I talk about dividends and dividend stocks a lot on this channel, so today I thought I'd talk about something that is still dividend related but isn't an individual stock. Instead, it's an ETF. However, it is one that offers a very high dividend payment compared to other ETFs out there. You may have guessed it, but today's video is all about Vanguard's FTSE All-World High Dividend Yield ETF, ticker symbol VHYL. We're going to break this down. We'll talk about what it is, what it offers, its diversification, its costs, its past performance, everything dividend related, and what type of investor may or may not want to add this to their portfolio. So what actually is the VHYL? Well, it's an ETF, obviously, by its name. And just by the fact that it is an ETF, you know straight away that you're not just getting one individual stock, you're actually getting a collection of multiple companies. And you can see here that actually you're getting 1,806 different stocks by buying this one ETF, which I think is pretty good going. If you compare it to VUSA, which is Vanguard's ETF S&P 500 tracker, that's a mouthful. In that one, you're getting about 505. So even though it's called S&P 500, famously, you're getting just over 500 stocks. So you're getting way more in this. But then if you compare this to Vanguard's All-World VWRL, this is really testing my memory. In that one, you're getting about double the amount of stocks that you are in this one. So in terms of what the VHYL actually is, it's basically an ETF that tracks an index. So it's tracking an index called the FTSE All-World High Dividend Index, like it says right here. And this index itself has large and mid-sized company stocks, not including real estate trusts. And it is having stocks that are from developed and emerging markets. And of course, given the name, all of these stocks pay dividends that are higher than average. That's the point of the high dividend yield ETF. Like I said, from this ETF, you're getting just over 1,800 different companies, but you can also see some other interesting things here, like the price to earnings ratio. It's 9.8 for VHYL. And you can see this compared to a benchmark. Typically speaking, very typically speaking, generalizing this, a lower PE ratio often suggests an undervalued company that could be a good buy now for the future, but a high PE ratio could also suggest that a company or a fund even is really aligned, ready for growth. You've also got the return on equity here. This is basically a measure of the company's net income, and then that's divided by the shareholders' equity. So it essentially gives a gauge of how profitable an organization is and how effectively it is actually generating the profits. So the higher that the ROE is, so the return on equity, the better that the company is at converting its equity into profit. I guess 12.7% is not really that high. So for example, Rio Tinto sits at about 35% and Johnson & Johnson comes in at about 25%. But of course, you've got to remember that this is an ETF. So this is the average of all the stocks in this fund. So let's have a look at the region exposure. Of course, this is a global, it's called an all-world, so you would expect it to cover the entire globe. It's heavily favoring North America with 48.1% focused exposure on North America. But then again, I guess you would expect to see this because obviously most of the global companies are in North America, so it makes sense, and that is probably quite balanced. Coming in second place in exposure is Europe. Again, you'd probably expect to see that. But I'd like to highlight you've got this emerging markets, and this is actually quite high at 11.8%. So I guess you would need, as an investor, if you were looking to maybe start investing into this ETF, you would need to decide whether you think emerging markets as a region are going to do well in the upcoming future, or do you think they're not? Because 11.8% is quite high. If you look at some of the other global ETFs out there, you'll see that they're not quite this high. They probably come in at around 10% or just over 10%. And of course, the emerging markets are places like India, Brazil, China, Poland, Russia, and so on. And as someone that wants diversification, seeing this would be quite reassuring, because you're not just focusing on the developed areas in the world, and you're actually really diversifying across the different regions. Now, if we look at market allocation, so this just breaks it down further and tells us what percentage of this ETF is focused on different markets around the world. Again, the largest one is going to be the United States. We expect that. The largest economy in the world is the United States. If we were seeing this figure at a really low amount, like, I don't know, 15%, 10%, you'd be a little bit concerned, like, where is this actually coming from? But it is still the largest holding, but we're getting lots and lots of other companies, lots of other countries in here as well. Like I highlighted, you're getting some of the emerging markets. You're also getting the UK, Japan, Switzerland. So you are getting a lot of areas around the world, which is of course good for diversification. And you can see here that obviously it tells you what region each of these countries are in case you didn't already know that. So if we scroll further, we'll see the sectors, which I think isn't always an interesting one to have a look at. So with the VHYL, the largest sector by percentage is the financial sector. And then that follows closely. No, it doesn't follow closely. That follows with consumer staples at about half that amount. And you can see the split here actually. I guess you could say that the technology sector, has that already boomed? Is that going to carry on growing at the rate it has? If it is going to carry on growing, you'd probably want a higher percentage than this. Or has it actually come to a halt now? You could also look at financials. If the world is going to carry on struggling economically speaking, and more recessions are going to happen, you know, all of this stuff that we keep hearing, then the financial sector is probably going to get hit quite hard, which could mean that having the largest percentage is going to mean that this ETF is not going to do so well. But you could then counteract that with the fact that the consumer staples sector is coming in second. We all know that during recessions and during times of economic downturn, people are going to be prioritizing consumer staples and healthcare because they have to, right? They don't need to go out to a restaurant or buy new clothes, but what they do have to do is they have to eat, they have to buy essentials, healthcare if it's necessary, and so on. So yeah, a further dive could really be done into this for sure. But also with this ETF in particular, like I said, it's comprised of just those high dividend stocks. So typically speaking, again, the high paying dividend stocks do tend to be the banks, they do tend to be the energy sector, they tend to be very sector orientated, if that makes sense. So again, this is not surprising that we would see this split here really. And lastly, in terms of what holdings you're actually getting, so what companies by percentage are you actually getting if you buy this ETF? The largest one is Johnson & Johnson, which I think if you watch any American dividend investors, or you speak to any American dividend investors, you can almost guarantee that they will have Johnson & Johnson in their portfolio, or at least they will know lots about Johnson & Johnson. We've got JP Morgan, we've got Nestle, which is obviously a Swiss company. We've got Pfizer, we've got Pepsi. You know, we've got all of these big names that if you're interested in dividend stocks, you'd have heard of them for sure. Let's go to the next page. Samsung, Shell, AstraZeneca, McDonald's, and the list just goes on. You can look through this indefinitely. Unilever, like I said, you're getting over 1,800 stocks. So Diageo, obviously a big UK one there. So I'm not going to go through every single one that you have, but yeah, there's lots here and lots of massive household names as well. I guess one thing to point out is that if you look at maybe VUSA or any other global ETFs that aren't focused on dividend companies or high dividend yield, what you always typically see is that Apple, Microsoft and Tesla and other companies like that, they're always the largest holdings. But of course, that's not the case here. And that is because Microsoft and Apple, they just don't have a high dividend yield. And of course, Tesla doesn't pay a dividend, so that wouldn't feature anyway. I imagine, I haven't actually looked, but if you keep going, you'll probably see Apple and Microsoft maybe pop up at the very end in such a small percentage, but maybe you wouldn't even. I don't know without looking. But these are the companies that are paying those high dividend yields. So you're not going to expect every company that is very well known to be in here. So let's get on to the juicy stuff, the dividend section of this ETF. The dividend yield is 4.46, which I actually think is really high, especially speaking for a fund. This is very high. This is very respectable for sure. They pay quarterly dividends, so they actually pay, let's do this logically, they actually pay in March, June, September and December each year. So you're getting that split 4 times a year, which is great for reliable income coming into your portfolio. Let's now jump over to Dividend Max, a firm favorite on this on this channel. Let's take a look at their annual dividends. So we can see here that this fund only started in 2013. I think it was May 2013 it started. So it's not been around all that long. About to celebrate its 10th birthday. So happy birthday to this fund soon next year. Anyway, so from 2015, it looks like, let me just check. Yeah. Okay, so from 2015 to 2019, they increased their dividends year on year, annually increasing their dividends. They had a drop in 2020, like we've said many times before on this channel. I mean, it's expected. Everything dropped in 2020. We know that. We can cut them some slack there. In 2021, it picked up again and increased from the high of 2019. So it looks like they are increasing their dividends year on year. So that's a good thing to see. That's a good thing for a dividend investor and a dividend growth investor to see. So now let's take a look at its performance historically. Like I just said, they only started in 2013. So there's not that much data to go by really, comparing it to some other funds that have been around for decades upon decades. It's not that old. We can see that in the last, let's do 5 years, they've increased by 6.33%, which isn't an awful lot. But of course, look, we had that massive drop that would have affected that in 2020. 1 year, not even 1%, but year to date, it's down by nearly 5%. But if we look at that compared to, I don't know, let's just look at VUSA. What have they done over the last year to date? Yeah, so they're down by slightly more. And that's just because of the different companies that are making up these different funds. It's kind of expected. Let's now look at the last 1 month. It's down by nearly 5%. And of course, we could look at this over different time periods. But if we max it out, we can see that it had a massive growth during this period here, and also a massive growth following 2020 in this period here. So although it doesn't look great over, if you look at the percentage, they have gone through times of really fast and high growth. But of course, past performance does not indicate future performance. And you also need to think about that the best way to have this fund would be, of course, to get those dividends and reinvest those dividends back into it to buy more, to increase your position. So, of course, then you can increase your dividends and it just keeps flowing and flowing and flowing. So the cost of this fund, given that it is a Vanguard fund, we would expect it to be quite cheap. Vanguard tends to be very cheap. The ongoing charge comes in at 0.29%. So that is basically the management fees, if you will. Obviously, the most cost-effective way to keep this would be to hold it within an ISA account or a tax-efficient account, the equivalent tax-efficient account in your country, just so you're not paying tax on those dividends. And if you sell the position, you know, it would be more tax-efficient and cost-efficient to keep it within an ISA account or the equivalent. If you buy this, I should point out that you can buy this outside of Vanguard. You don't need to have a Vanguard account to buy this fund. If I just go on to my ISA provider, which is Interactive Brokers, I can get hold of this if I want to. But of course, it's always worth looking at what transactional fees and what other fees may apply on your particular platform as well, because I can only see here for Vanguard, of course, but it changes depending on what platform you're buying it on. But it's good to know that you can get it pretty much wherever you're looking. So I guess the last thing to speak about is who would actually want this ETF in their portfolio. Straight away, we know that it would be someone that is interested in building an income from their portfolio, someone that has interest in dividends, because it is a high dividend yield based ETF. If you're not at all interested in dividends, then maybe FTSE's All World, Vanguard's All World, VWRL. God, I hope that's right. I've said too many acronyms this video, too many ticker symbols. That might be a better option. Or of course, you've got an S&P 500 tracker. You've got the Global All Cap. There's many other funds that may be more suited if you don't care about dividends at all. But I think this is an absolutely fantastic fund if you do care about dividends, but you're someone that maybe doesn't want a stock pick, or you just want more diversification. This is not the most diversified, of course, because it is selecting those high dividend companies, but it is way more diversified than if you picked 5 dividend stocks and that's all you had in your portfolio. So I do think it has its place. I think it is a great fund. I may or may not be considering adding this to my portfolio, but I'm going to leave that for a whole separate video. So that's it from me today. If you've got this fund or you're interested in this fund, you've got anything to say, leave it in the comments below. But thank you so much for watching, and I'll see you very shortly in the next video.